Hello, everyone. Thank you all for joining us for the Small Cap Insights podcast powered by Darrow Associates. My name is Jack Greenberg. I'll be your host for today. We are a leading full-service investor relations firm focused primarily on small cap equities. Joining us for today's episode is Michael Bacal, a managing director of Darrow Associates. Michael, it's great to have you. Thanks for joining us.
Thanks for talking to me today, Jack.
Yes, sir. So let's start off with your professional journey. Can you kind of walk us through how you ended up at Darrow?
Sure. I did not start off my career thinking I was going to do investor relations. I actually went to law school, passed the bar, and was initially working as a lawyer for a regional manufacturer in California who was going through some problems and was stumbling into Chapter 11. I was not only in the legal department, but it was a smaller company. I was the senior staff to the officers of the company. And the CFO didn't love talking to the investors. So my first blush with investor relations was responding to returning phone calls from people who were shocked, despite generous amounts of warnings in our public filings, that their investment had filed for Chapter 11. And so, needless to say, I have the scars from that first experience. That led to me being involved with corporate communications and our proxy and disclosure. And a couple of years later, when the company decided to establish a full-time IR position, I was selected. I built the practice from scratch. We built processes, procedures, grew with the company for 25 years. There were through three changes of CEOs. The third guy basically wanted to have his own person there. I left them, having watched them grow from a $300 million company to a $2 billion company at the time of my departure. So it was quite successful. I met Jordan, and Jordan gave me an opportunity to continue practicing IR and take what I learned over those 20 plus years of doing it for a NYSE mid cap company to apply it to the small cap market. And it's been a fun journey so far.
Yeah. So you've kind of been on both sides. What advice would you give to executives about how to work most effectively with their IR team and maximize their investment there?
So the first thing to say is don't shoot the messenger. Executives need to remember that the IR team is on their side. They're the ones out there being your scout. They're talking to your investors, both retail and institutional. They're taking the hits for you. They're getting yelled at. They're getting the nasty questions fired at them that folks are reluctant to say to a CEO because they're afraid they won't ever get a chance to talk to them again if they ask that question. So don't be afraid to, don't shortchange what your IR person's telling you. They're not trying to upset you. They are gently trying to inform you what your shareholder community is concerned about. And they're just your eyes and ears. So, as I said at the outset, don't shoot the messenger, even if you don't like the news they're delivering.
Yeah, that makes a lot of sense. And you mentioned talking to investors. What's your feedback process and how do you help executives incorporate that feedback into the messaging?
So, too many IR practitioners are strictly in sales mode. They've got their talking points, and almost like a politician, regardless of what the investor is asking or saying, they're going to circle back to those talking points and keep reiterating that. And don't get me wrong, having certain issues you want to cover and certain ideas you want to get across is very important. But it's equally important to listen to what the investors are asking about, because those are usually the matters that are helping to drive their investment decisions. Do they want to stay? Do they want to sell? Do they want to increase their position? Are they concerned with management's processes and how they're running the company? So it's very important to listen to what the investors are asking you and then take that information and mark it down. And what you'll find usually is there are patterns. it's not just one person who's going to ask this type of question. It's not, they're not going to be the only one asking about a company's push into the franchising business. It's going to be a topic many people are going to ask about, and they're going to ask about it to varying degrees of intensity. But once you've heard the question repeatedly from retail as well as institutional guys, it's important to give that feedback to management and then look to incorporate it into future disclosures. It could be doing it quarterly as uh, an aspect of your earnings call or just simply the earnings release or your 10Q. It could be in a newer, in a guidance release, certainly in that venue. But you need to try and get those ideas out there to answer, to show the company's being responsive and listening to their shareholders. And quite often, these questions arise because the shareholders either are missing information, they've overlooked something the company has disclosed, it's not clear what you've disclosed, it's causing confusion on their part. So it's important to take that feedback and clean it up and then reissue it in other vehicles. And you let that new information become one of your talking points that you're using when you're speaking with investors.
Yeah, that's great. You mentioned guidance releases. How do you approach that? And do you believe that companies should issue guidance, or why not there?
Guidance releases are a charged topic. It could build or destroy a company's credibility, management's credibility. So while people think it's easy that you just throw some numbers out there and everyone, oh, company's going to beat and raise and they just keep buying, it's not that simple. Before you think about guidance, you need to have confidence in your finance organization and your planning group. You need to know that what your plan is and how well you're tracking against that plan. Now, companies can do this in baby steps. You don't have to go out and give quarterly guidance. Many companies have gotten away from quarterly guidance because there are unusual events that happen, a tariff blow up, a strike in a shipping ports that screw up deliveries for one quarter. Maybe there's seasonality. Uh, and it's easier to give guidance on an annualized basis. Usually, you're doing an annual plan to begin with. You see how you're tracking to that plan, and you can adjust that plan accordingly when you're doing your earnings releases. So, for a company that's confident in their planning process and think they're going to come out at or above those levels, you can go for it. You could start off slowly, start off with annual guidance, start off with key metrics, just a few of them. Could be sales. Maybe EPS is hard for you to calculate. Maybe it's a cash measurement you want to use. And that can help build confidence in the company and in management's credibility. They can, it can actually lead to investors becoming more comfortable that management knows what it's doing and has a good handle on the markets they're serving and what's going on. And then you have to update it. You don't have to update it every quarter, but you can update it semi-annually. And it's okay to make it lower. It's going to hurt the stock price. That's why some people shy away from guidance, because if you put numbers out there and things go wrong, your stock's going to be punished. It's going to hurt. So that's why you need to have some confidence in your other elements of your organization, in the finance and the planning organization, and be confident that the information they're sharing with you and how you're thinking about the year ahead is how it's going to unfold, or at least how it's going to unfold that you could do better than, that it's a minimum level of performance. And look, sometimes companies enter periods where the year ahead is going to be difficult. It's going to be hard to achieve, to even mimic last year's and repeat last year's performance. Sometimes it's good, rather than surprising people, to put that guidance out there and explain why this year is going to be difficult versus last year. What has changed? What the company's doing to respond to those changes? Are they adjusting their workforce? Are they doubling down in R&D? Are they spending on new facilities to produce the product because there's a shortage or there's something new entering the system or they see growth in the future? And this is just a pause that refreshes, as they say, while you're working through those issues. So, guidance is not something to just be done in a cavalier manner. You need to look at the other aspects of your organization, and then you could put forth a coherent plan in how you want to disclose how you think the company will perform in the periods ahead. Go for it. It's great. But if you don't have that confidence and the other arms of your organization can't generate those numbers for you, it's not something you should trifle with.
Yeah, I think that's a great answer. And just final question, kind of on a separate note here. Have activist investors ever engaged any company that you've been working with, and kind of how did you handle that?
So back in my youth, when I worked for my longtime employer, we did have an activist show up. Luckily today, I have not experienced it in my recent roles at Darrow. But back in the day, we had an investor who was an activist who asked questions. They were legitimate questions. The company didn't give a lot of guidance. We were just talking about that. The company wasn't comfortable with its planning organization. It oftentimes got things wrong. It was concerned about proprietary information. It was in a duopoly type, oligopoly type market, and it didn't want to share too much proprietary sales information with its competitors. So it was very tight-lipped about what it was doing, how how things like CapEx were going to translate into future sales, what its return on investment was going to be. It had multiple divisions with multiple products, so it did not want to share product margin information for fear of losing competitive advantage. I heard all this and passed this along to management, but management was more concerned with maintaining their moats, keeping information private, and didn't think it was important enough to increase our disclosure. Well, after a couple of bad quarters of underperforming compared to what the street had expected, this activist decided to make an issue of it. And we wound up eventually going to a full blown proxy fight with them putting up a slate of directors for, I think, one third of the board. And we went all the way out to investors. And in that process, the company changed. Management, the CEO was a little humbled. Um, he took the feedback, he listened to what the activist was asking for. And as part of that proxy process, we greatly increased our level of disclosure. We gave a lot more information, not exactly as much as what the activists wanted. We didn't get down to the product line margin level, but compared to what the company was disclosing before, it was like night and day. The company wound up prevailing. We won handily in the proxy fight. Um, and then going forward, the company kept up that new level of guidance and disclosure. And as a matter of fact, shortly after that event, we had a new CFO who had previously been the company controller. He was the accountant for the company. And he asked me repeatedly, I don't know how you dealt with investors before we changed to this new, more fulsome level of disclosure. I don't know how you guided them in any direction. And it was challenging. Um, it made the company better for the experience. It was expensive, it was painful, but it did force the company to really look in the mirror and reassess how it was communicating and what information it was conveying. And in the long run, it did make changes for the better.
Yeah, I asked that because I'm always very interested in how investor relations handles those situations. But that's all great. Thank you again, Michael, for joining us, and thanks everybody for tuning in. to another episode of the Small Cap Insights podcast powered by Darrow Associates. If you enjoyed today's conversation, want to learn a little bit more about how strategic investor relations can help elevate your company's visibility and credibility in the market, please visit www.darrow.com. We help companies communicate their value proposition, build long-term relationships with the investment community. See you all in the next episode. Thanks again, Michael.
Thanks, Jack.